Hi there folks, and welcome to this edition of Views from the Top. My name's James Marley, I'm a co-founder of Livewire Markets, and in Views from the Top, we speak to investors who are at the top of their game and find out what's catching their eye in markets today. Now there's a general rule of thumb in markets that you should be able to double your money every 7 years. My guest today has managed to double the capital in his fund in just 5 years, an awesome return with the QVG Capital long-short fund up 102% since it launched in May 2019. The person in charge of that fund is my guest today, Josh Clark, portfolio manager at QVG Capital. Josh, great to see you.
Thanks, James. You too. Happy to be here.
I'm looking forward to getting into our chat about what's catching your eye. We'll get a bit of masterclass in short selling and learn about some of the key holdings in your fund. But when people do think about short selling, the Bobby Axelrod iconic type figure comes to mind, a swashbuckling, very enigmatic character. You're very mild-mannered, bit of a different style persona. There's no Bobby Axelrod living with inside you?
I've never thought about that too deeply. And look, honestly, I didn't expect you to say that, but it brings back a memory in that when I met my wife, I tried to explain succinctly what I did for a job, and I used Bobby Axelrod as an example. How
did it go?
She since, look, I don't know how she took that. I don't know if she thought it was funny or if I was being serious. We're still married, so that's a plus, but I think she's worked out that I'm not Bobby Axelrod, so
yeah.
I'm not sure where that leaves us.
Well, definitely my observation over the years is quite the opposite of the Bobby, very mild-mannered and considerate and take your time thinking through things. So I'm looking forward to our chat today. I had a look at one of your recent monthly reports, and it showed that you're carrying a larger than usual or historical average net long position. Does that mean you're bullish or finding more opportunities? What does that mean?
Look, it doesn't necessarily mean that we're bullish on markets. It does speak to the opportunities. I'd caution people reading our monthly, especially our investors, to look at our net positioning or our market exposure and try and derive from that or infer from that a view on the market. Really, and our investors will find this statement really familiar. What we're trying to do is move the weight of money in the portfolio to wherever the best ideas are. If they're long ideas, great. If they're short ideas, great. We're just trying to find absolute returns for our money. So our net positioning is typically a function of that. It's maybe a little bit elevated as well because we've come off a period of good performance. So the long weights tend to go up naturally. Yep. You're fighting that, and the short weights tend to go down when the portfolio is performing. So the net exposure is somewhat a function of that. If you want a view on markets, you're probably going to be disappointed with what I've got to say next. I mean, if we look at valuation metrics, the market looks a little bit expensive. So I wouldn't necessarily call myself bullish on markets or bearish on markets, and I won't give you that old cliche of being cautiously optimistic on markets, but I would say I'm open-minded because what we've seen over the last handful of years is central banks moving the goalposts. It seems like almost every morning you get out of bed, there's a different data point or a different rate setting, and it's really the view of inflation and what central banks are doing around rates that is changing what the absolute valuation of the market is and should be, and that's incredibly difficult to predict. So rather than forming a view on markets and trying to predict that, we're trying to form a view on stocks and place our money accordingly.
And what are some examples of the long ideas that have done some of the heavy lifting in the portfolio for you?
There's a few. We've had some results over the last week that have worked for us. So something like a Xero or an Aristocrat have done some heavy lifting in the last couple of weeks, with them having that May reporting period. If I look at things that have gone into the portfolio more recently, and if you look at it by weight of money, to be a bit more black and white about it, the things that have gone in on the long side have been stocks like car sales, Light and Wonder, MMA Offshore, Supply Networks, Zipco, probably the top 5 by weight of money, and that probably sounds a bit eclectic, that mix.
Yeah, I was going offshore oil drilling. You've got an online marketplace. Yep. Zipco, a bit of a beaten down darling.
Yep, that's right. So I hope you let me explain myself, because it does sound eclectic to me, but I'd put them in 2 buckets really. So MMA Offshore, Zipco, I would put in the turnaround bucket. It's not typically the idea that we're trying to look for, but We do like to have as broad a spread of ideas in the portfolio as we can possibly find. The other three, I would say, are much more...
Is that important for getting those uncorrelated returns to the market? Is that how you're trying to achieve that, sort of that absolute style approach by not having stocks that are moving in a similar way to each other?
Yes, is point number one. So, I mean, if you can have your returns uncorrelated, then great. But we're not always trying to get our cake and eat it too. We understand that some of our ideas are just going to be correlated, and that's the way it is. And if we're searching for return, we're just looking for the best ideas. So that sort of dovetails into the second reason I'd say that you want to have a broad spread is not only do you want all your stocks you don't want them to be performing all the same way at once, but if you're going to try and squeeze the most return out of a portfolio, I think you've got to admit to yourself that the Australian market is just not broad enough to have all of your stocks in one type of idea. Imagine if you tried to have a portfolio full of turnaround stories. You're going to own 2 stocks or 4 stocks maximum. Or if you tried to have them all in growthy stocks, you're probably not going to hit that quality threshold with all of your growth stocks.
Yep.
So I think you need to be optimistic around multiple ways of making money with an underlying philosophy that overlays all of that.
Yep.
Yeah.
So back to the buckets.
Yeah, I was going to say the turnaround bucket, you'd probably put MMA and Zip in the turnaround bucket. So MMA really is the antithesis of what we're typically looking for in a long idea, and not typical for us. So when I say the antithesis, really it's a capital intensive cyclical, but I think the value that was on offer in that business recently with how much price growth and utilisation growth that you were seeing in there was just too good to ignore, and it was quite clear that the market wasn't appropriately pricing the operating leverage within that business. So that's a company that's been taken out, so we don't have to worry about that one anymore. Zipco, also a turnaround story and has done well for us. It's a business that I'd like to say that we had a reasonable level of understanding of, given we've been short in the past. So what I could see there was really a balance sheet that was being rapidly de-risked and turned around. It takes a lot of risk off the table. Some changes in management. We do highly rate the CEO, and that sort of leads into the second point, which is the cost out story and the margin optimization story. And then often it's hard for businesses to transition beyond those two things in a turnaround. But what we're seeing in Zip is they're really adding the third leg to that story, which is revenue growth. Particularly in the US, the environment for some of those buy now, pay later stocks has changed. So the revenue growth I think is becoming a little bit easier to come by, but also it's coming at better economics where they're having to spend a lot less marketing to acquire those customers.
Yep.
And then if you just let me quickly round off on the other three, I'll try and be brief. So I'd call them stalwarts. So high returns on capital, double-digit revenue growth, I think across the three of them. Sustainable competitive advantage and IP in there. You probably don't get a lot of multiple expansion out of those three stocks, yep. But I think you get a market plus type return out of the earnings growth.
Yep. I noticed in your April report, EML Payments popped up. It's had a checkered history,
yep.
And a few struggles, and I think it's a stock that you've owned historically.
Yeah.
Can you tell us a bit of a background on your relationship or your ownership of EML and why it was back in the portfolio?
Yep, I can do that. Forgive me for the walk down memory lane, but I had an investor contact us, it might have been 2 weeks ago, maybe 1 week ago, and they said, surprised to see EML in your monthly, do you still own that thing? And I thought, for a bit of context, I've got to give him the trading history, and I did. And what that showed was we were long the stock in 2019, 2020, 2021, buying from anywhere between 250 to 350 was probably the bulk of the buying. Ultimately exited that position around the $3 mark, maybe with the weight of money a little bit less. So we were break even to loss making on that position. So it was a pretty poor use of capital over that time period. And what I got wrong was I'd overestimated the operating leverage within that business, but also the PFS acquisition, the prepaid financial services business in the UK that they bought. Was a real problem for them. So there was an unsustainable business in there, regulatory oversight became a significant burden, and you saw costs increase as a result. And we're in a pleasant position, I guess an unpleasant position in terms of not making any money out of the position, but pleasant in that we had that background knowledge, and things were so bad with that acquisition that we were able to get short rapidly upon exiting that long position. So we made up for some of the sins of the past by making, I know we covered that position around 66 cents, so where are you, 75, 80% type return on that position. And we're probably just in the right place at the right time with our understanding of that stock to be able to see that unfold. Equally, I think we would have been one of the few funds that were really staying on top of the story right into the deep, dark depths of microcap land where everyone's had enough and they've forgotten about the story. We're still paying attention because we're short that stock and we need to cover at some point. And what we saw was a new management team come in. So look, there was individuals on the board who had good skin in the game, who really incentivised to make it work. New CFO. There was an activist fund on the register that was really agitating for change, so we could see that it had the potential to happen quickly. And then also the former CFO of Afterpay became the chairman. So we saw what looked like a really sensible group of people making all the right noises around what needed to happen within the business. So that was a catalyst for us to get long the stock. And really,
do you switch from covering a short straight into the long position?
I'd love to sit here and say yes, we do that all the time, because it works so well. I can't say that to you because we've had a handful of examples where that has worked well, but more often than not, you're biased to one particular direction on the stock. Yep. So we've found long positions that we've exited well. We haven't necessarily always gotten short. Same with shorts that we've covered well. We haven't necessarily always gotten long. So I've got a few good examples that make us look like heroes, but the reality is that's probably a source of opportunity in the future.
Yep.
Yeah. And just to finish off on what we see in EML from here, so they've had the balance sheet fix up, they've gotten rid of the cash burning businesses, they've implemented a lot of cost out, some revenue optimization. But I think from here, with what management think they can do in terms of revenue growth, which is they're forecasting below where they've been in the past, and what they think they can do with more cost optimization, you only need to imagine the stock on a single digit multiple in the future for the stock to have a lot of upside. So currently long the stock.
Yep. I was looking back through your performance history. 2022 was a difficult year for a lot of funds with a growth bias or growth style. It was a difficult year for your fund. Is there anything in that? Should people think about an allocation with you as having a growth bias?
You've gone and highlighted like the worst period of performance in the fund. I should do a Brad Banducci and just walk off and say that's it. Interview over. I came here in good faith. Don't want to talk about it. But no, you're right. So the first half of 2022 was the most difficult period for us in terms of returns. What happened within the fund is really, both then and now and typically, we tend to have a concentration in our higher weights in the long book towards higher quality, higher growth, long duration businesses. We did at the time. There was a really rapidly rising rate environment, and those businesses are particularly sensitive to moves in valuations. If I cast my mind back to a webinar that we did in October 2022 where we tried to explain what was happening within the portfolio to investors, one thing that I did was I pulled up a chart of Aristocrat, which is one of the large detractors. It was one of the large weights, and it describes, or it's a good example of what I've described happening. We know through quantitative research that the change in the multiple is a very big component of your short-term returns, and it's a very small component of long-term returns. It's earnings growth on a per share basis that dictates long-term returns. And so we broke that down in that webinar on that chart with Aristocrat as an example, where you could see that they had really good long-term earnings growth. We had confidence in the future of their earnings growth trajectory, but they'd just really been crunched on the multiple. So I think if you look at what's happened since, again using that one as an example, from that October time period, Aristocrat has continued to deliver that earnings growth, and it's been rewarded. So I think your return from there has been around 35% on that stock, and they delivered a well-received result a week or two ago now. So I think there's a real distinction, because we could go to sleep at night going, I know that I'm going to get my earnings. The multiple compression is behind us and the earnings growth is ahead of us. But you can only go to sleep at night thinking that if you're confident that you own high quality growth. So there's a lot of, don't want to use the word spivvy, but let's just say low quality growth businesses in 2021 that weren't delivering the numbers, weren't giving you the earnings growth, that just haven't come back. Yep. But the type of stocks that we favour, they're the stocks that we had the confidence in their earnings continuing to power on.
Yeah, well, let's talk about, stay on the multiples path. WiseTech, Hub are companies you own. They trade on high multiples. How do you make a case for owning stocks that are optically expensive?
The obvious point to make is that they trade on high multiples. A multiple is, often the market cap relative to the earnings. So you're typically looking 1 year forward, and on a business with really static value, it's a really good shortcut to look at valuing a business. For a business with dynamic value, or a business that's creating value through time, it has a few areas where it really falls short. So specifically businesses that generate really good returns on capital, because you don't necessarily appropriately value the cash that you're getting back in and the lack of reinvestment the cash you're getting out and the lack of reinvestment back in, but probably more so on the mathematics side when it comes to businesses that grow at high rates, or businesses that grow for longer than you think. And I think the market structurally has a problem with pricing the duration of growth.
Yep.
Probably on both sides of the coin. So that heuristic just doesn't, it's not a good way of wrapping your head around long-term compounding. So for businesses that fall into that category, you mentioned WiseTech, Hub, but you could take a lot of other high growth examples. With businesses that are that special, that grow at those high rates and have that long duration of growth, you really need to be looking beyond 1 year, 2 year, 3 years, because the bulk of the value in the business is in those cash flows that are further out into the future. So really what you need to be doing is identifying as many qualitative insights as you possibly can to understand what the ultimate destiny of those businesses look like, then going a little bit further into the future, which is scary because your ability to forecast...
Margin error goes up, right?
That's exactly right. It is right. I mean, you could debate against that when you're buying a business that is of a high enough quality with a good enough management team, that there's maybe a little bit of positive surprise that's not priced in there. Yep. But really what we're doing is putting those qualitative insights into a longer term model, discounting that back, coming out with an internal rate of return, and then investing in the ones where the internal rate of return gives us a large enough margin of safety for us to be wrong on some of those forecasts and still make money.
Yeah.
Yeah.
You mentioned Hub. It's in sort of your area, it's a platform for advisors to access funds and that sort of stuff. Yeah. It's relatively competitive landscape. What's the thesis behind your why you're backing Hub?
I think there's a few components. I actually find it a fun one to talk about because I first came across the business in 2015 when it was not too far off break even. So I feel like I've got a little bit of context with the journey on Hub. And the other reason I like talking about it is it really ticks all the boxes with respect to the types of businesses that we love to put in the portfolios at QVG Capital. So some of those boxes would be sustainable competitive advantage, IP I guess goes into that, high returns on capital, operating leverage, a really good long runway of growth. I think in that business it's got some natural tailwinds, one of which being markets typically move up over time, so you get that as a benefit over and above what they're doing internally in that business. I think early on in the journey, the enduring insight that we came across was that they were one of the earlier movers in managed accounts. They were also a non-bank aligned platform with a good product, and that's where the market was moving. I think some of those, or those two insights in particular, are probably a little less relevant these days, as some of the other platforms have caught up in that respect. But I think the insight now is you've got Hub and also their key competitor NetWealth, which is a very analogous business. They now have enough scale in their product development, research and development to have developed a really strong rivalry between the two of them. And it's quite funny, on any day of the week you wouldn't know who's got their nose ahead because they're competing so intensely to deliver the best service, the best product and the best features. So, look, I can't tell you who's going to win that race, but the side effect or the peripheral effect, if you will, is all of those legacy platforms that still have the majority of market share. They can't keep up with these two that are duking it out and spurring each other on. So that pace of reinvestment in the platforms really leads them to be quite a long way ahead of the competition. So you can see this long runway of growth. We've actually got a slide in our webinar that shows the journey of that earnings growth to date. And there was another point that I was going to make on those two. I think, probably maybe just around the near-term outlook, because you want to have a bit of a combination of both. So just thinking about the near-term outlook with respect to Hub at least, it seems like advisors have really picked up the level of activity relative to 12 months ago, so that should be good for flows. I think there's been a lot of M&A in practices where Netwealth and Hub typically are beneficiaries of consolidation. There's probably a bit more tendering activity than we've seen in the past for platforms. And then you've also got one-off unique events like the MLC migration from the MLC platform to Expand, which potentially is a bit of a catalyst for change. Yep. So really what we're doing is putting what we know about the business long-term, short-term, all into the mix in terms of that internal rate of return that I talked about. And with Hub, we just keep getting double-digit rates of return. So it deserves a spot in the portfolio.
And that's a top 5 position?
I think it would be just outside of the top 5 for the long-short fund.
Let's switch from the longs to the shorts. And as I mentioned in the introduction, we'll get maybe a little bit of a masterclass, or at least a bit of, take us inside the world a little bit. On Market Index, we've got the short sales data, which is always very interesting. It shows, as I look at the moment, Pilbara is the most shorted stock, followed by IDP Education, Cyro Resources, Flight Centre, Liontown. When you look at that list of most shorted names on the market, what information does it give you, and how do you think people can interpret that information?
Look, I'm always in the habit of going straight into the stock specifics on each of those names, given that's what we do day in, day out. But if you want to have a bit more of a holistic picture on what that list tells you, the first thing that I think of when I look at that list is you've probably got positive returns. If you were to go and short sell all those stocks, you're probably going to make money, and you're probably going to have a very odd payoff structure. So why I say you're probably going to make money is, there's a reasonable amount of quantitative research to suggest that highly shorted stocks do underperform markets. So there is information in that if you go and have a look at what the most highly shorted stocks are. But they're also crowded trades almost by definition. So your base case with selling highly shorted stocks is probably those stocks would tend to drift lower over time, or at least underperform the market. But as you'd probably know, if the news is not as bad as feared, or even good news in any of those, there's a reasonable probability that those stocks are going to go upward at a rapid rate. So for those not familiar with a short squeeze, you've got, particularly in that list, a highly concentrated number of shorts in that position. If the stock starts moving upwards, not only have you lost money, but your problem is getting bigger because the weight of your short is getting bigger. So you're thinking, at the very least, I would need to risk manage and buy some back to take it off the table. And then if you do that, then the guy down the street who's also short, he has the same problem to an even larger extent. So that can turn into a bit of a vicious cycle. Yeah, so your payoff structure's one to be mindful of. It's like picking up pennies in front of a bulldozer to some extent. And then on the stock specifics, if you can get down to that level, then great. Pilbara looks like one of the most liquid ways to play a thematic if you think that the outlook for lithium is weak. So I'd argue that's where a lot of that short interest comes from. Personally, I wouldn't want to short sell a business that has a strong balance sheet and is down the bottom of the cost curve. I want to sell the ones that have the weak balance sheet and are really marginal on the cost curve. And some of the businesses that you've mentioned in there are losing money. And then you also want to differentiate between short-term and long-term problems. IDP Education, I think, has got some short-term headwinds that maybe mean near-term forecasts are a little bit high. But ultimately, those short-term headwinds, I think, will result in increased market share for that business. So there's a bit of a time horizon thing that you need to be careful of. And Flight Centre is probably the last one that I'll mention. That doesn't necessarily look like a fundamental short, at least for a lot of that, given they've got around, I think they've got around 600 million worth of convertible notes on the balance sheet. And I hope you forgive the jargon, but some of that short exposure will be a delta hedge against those convertible notes. So it's there for a non-fundamental reason, I think.
What's it like? Have you been on the receiving end of a vicious short squeeze?
All the time, yeah. Yeah.
What's it? Can you give us an example? Tell us what it was like.
Look, I haven't really thought about which example I'd use in advance, but the one that just popped into my mind was Megaport. So I might as well talk about that one.
Yep.
There you go. You've squeezed that out of me that we were short Megaport. I'll get in trouble for saying that. I mean, yeah, that was a reasonably successful short for us. Basically, the numbers were just so good on that first upgrade, and it was a huge price move. I'm trying to remember the quantum. I'll get it wrong, but think 30%, that type of range. But then, you know, you just want to be as level-headed as you possibly can be. So keep it focused on the numbers. So with that particular example, you could see a path to that stock trading much higher, given the amount of costs that they were taking out of that business. So that was just a flat-out let's cover this stock. So I guess we had the benefit in that one, in that we had fundamental news creating the short squeeze, and we were able to change the view and cover that position. There's a whole range of other stocks where that we short sell that can be really high beta stocks, and we might get stuck in a short squeeze just because other people are covering. You know, borrow might be getting pulled away, so short sellers' ability to stay short becomes diminished. And in those scenarios, quite often we'll just endure the pain because we know that the stock will eventually trade back closer to fair value. Yep. So there's a couple of examples.
And are you able to talk through? I know you generally don't talk specifics, but you know, some examples of the areas where you're finding shorts at the moment.
We don't like to talk too actively about specific names. We're not in the business of upsetting people and ruffling feathers, predominantly because there's just not a lot of upside in it. But I know if I don't give you specific names, it'll probably upset you. So two that I could probably talk to you about would be Bapcor and also Weebit Nano are probably two that come to mind. BAP because the CEO is no longer there and potentially there's some movement on the board. So I don't know if they're, you know, hopefully they're not too upset to hear that we've been short their stock in the past.
Yep.
And Weebit Nano, I think I've already been uninvited to a few of those briefings. So
a little badge of honour.
Yeah, the damage might already be done there. On BAP, it's obviously had a couple of downgrades recently. I think there's reason to be a little bit wary about the bull case from here though, because one, I think there's some. It sounds like there's some cultural and operational challenges within that business that are going to take some time to turn around. So you've got to think about the time value of money argument there. Two, you know, it sometimes gets talked about as a takeover candidate, but there's a bit of leverage there, and we don't know about what the balance sheet's going to look like at the next reporting date. We do know that there's articles in the paper talking about things like the warehouse saying, hey, no more inventory, we can't take anymore. So they're obviously cognizant of the balance sheet and potentially also cognizant of their ability to move those goods through the P&L. So that would be another thing to watch on BAP. But given it's been so beaten up and it's really been a cost-in story, the revenue hasn't been too much of a problem within that business. You should think that there's a reasonable amount of earnings power in there. So you've got to go back and go, okay, well, what is the earnings power? And looking at some of the competitors or looking at what Bapcor's done in the past, you're probably talking in the region of EBIT margins around it with a 10 handle. And I think at the last half, the EBIT margins are more like a 3%. You might be 3.3 or anyway, it starts with a 3 handle. So the business does have the potential, I think, to triple earnings. But then you've got to ask what you're being asked to pay for that business. And I think even if you get margins back to that 10%, and considering the time value of money, there's not enough upside to be really optimistic from the long side. So I actually feel like it's not skewed in your favour from a long perspective. And on Weebit, it's it's probably not a bad one to talk about because it does represent a whole cohort of stocks who have a great story to tell, a great presentation, a product that's going to be the best thing since sliced bread. But I think what we've seen there is, to put it in context, there's no revenue. We don't have a product yet. All we have is cash burn, burning probably 15 million per annum, I think, at last check. And if you look at some of the data points to work out if that product is going to work, I just don't think we have enough of them. I mean, one of them was supposed to be, I think it's Skywater, the partner in the US, who was supposed to be a customer of that business. But if you dig into the economics, it looks like they're more of a supplier than a customer. And it's much easier to win a supplier because you pay the supplier. It's harder to win a customer because they pay you. And then the competition that you're up against giants. And some of those giants have even tried this product in the past and it hasn't worked. So that's another one where the risk return from the long side doesn't look great.
So what's a view from the top that you've got that you wouldn't have had you not been running the QVG long short fund?
Look, I think there's a whole range of lessons that we could talk about. So I think you want to just keep it to what the most important lesson is, and I think that's focus on the maths. I think you have to worship at the altar of mathematics. That's what's driving share prices. I think too often in this industry, it's easy to get caught up in the story. It's easy to get caught up in the next data point. It's easy to get caught up in what this data point is relative to expectations. But if you continually focus on what the maths are telling you and what that means for that business's long-term value, then that can be a North Star and it makes decision making a lot easier. I think there's probably a couple of examples I could throw in. So I'll give you one on the long side and one on the short side. So recently I had one of my peers say, "Oh, well done on Lovisa. That's a stock that we held in a reasonable weight, and that was up around 40% in February." And I don't feel like we did anything particularly fancy on Lovisa. We certainly weren't geniuses. The people who need to have a pat on the back was the participants in the market who sold it and gave us that opportunity. The market became quite focused on comp store sales in that business. And if you want to model the business and understand what the value is, the value driver is in, as long as the store economics hold, it's how many stores can they do per annum and how many stores will they ultimately get to. They are the value drivers. So it was quite funny, through a period of like extreme share price volatility, our view of fair value didn't really change. So it was quite simple to just stay focused on the maths and add while it was depressed. And you don't know when you're going to get your return, but as long as you focus on the maths, you will get it. I'll give you one on the short side. Nuix was another one where at IPO we passed on that opportunity. If you read through the prospectus material, you could see that the business didn't really make any money. And I remember speaking to some peers of mine and I said, "Oh, we didn't buy any because it doesn't look like the business makes money." We're in a really hot tech market for what it's worth, and they both admitted to buying it, and they said, "Oh, look, yeah, I know, but it's going up." Ultimately, they were right. It did go up. I think it doubled. But internally at QVG, we just couldn't get our heads off the maths. So we ended up being the only ones short for a while there, which was a bit scary, seeing our short position equaled the total short position. But the maths were telling us that it doesn't make money, and they're struggling to grow revenue. And also, I won't get into some of the accounting issues, but what they were doing to make revenue was making future years' revenue growth even harder. So the weight of the maths was just completely stacked against this business. So I think sometimes you've just got to have blind faith in the maths, take the position, pull the trigger, and just have faith that you'll get paid.
That's the patient part of it.
That's the tricky part. Yeah. That's right.
Cool. Well, Josh, thanks for being so open. I know it's not something you do every day, talk about both sides of the book, but well done on your first 5 years. Long may it continue.
Thanks,
and
James.
Thanks for coming in and being so open with us today.
Yeah, appreciate it. That was fun. Thanks.